Okay, the next step is then to essentially split up that one line account, the interest in joint venture, and show each venturer's share of the assets and liabilities of the joint venture. Now, to do this, when everything that was put in by the venture was its carrying value was at fair value, is a pretty simple proposition. Again, if that's not the case, we're going to look at that in a later example. But in this case, all that you need to do is debit each asset in the joint venture, debit that amount by the proportion that which the venturer has. So A has a 40% share, so each item, cash, inventory, land and equipment, you show 40% of what is on the joint venture's books. We then do the same with liabilities. Credit accounts payable, $160,000, which is 40% of the $400,000. And we credit the interest in joint venture, whatever that difference is. And so that's a balancing amount. You can do these as two separate entries with just the assets and a credit interest in joint venture, and then a debit interest in joint venture, credit accounts payable, or you can just combine it as one, whichever you feel more comfortable with. On B's side of things, it's much the same process, except we're using 60%, and you can see that these two things add up to the full joint venture balance sheet.